Welcome back, guys. Rodrigo Fondor here with Asheville Real Estate News. Really excited to bring you this episode where we're going to dive into how you can acquire rental properties with non-QM loans. So it's kind of, if I understand it correctly, and this is going to be an education process for me as well, loans have residential components and commercial components that are going to hopefully open doors for you if you're looking to increase and add properties to your rental portfolio. So today I'm joined by Sarah Katzmark with Union Home Mortgages, and we're going to go over the overall concept and maybe what the first steps are to go down that road.
Sure.
So Sarah, welcome. Thank you so much for joining us.
Thank you for having me.
Absolutely. I know we kind of met at the last meetup that we did, and it was kind of started talking about this new product line that you are rolling out.
Yeah.
And before we dive into it, can you give us just maybe like the 30,000 foot overview?
Sure. So really what this is it's an investor cash flow loan. And so what we're doing is generally we're in the residential mortgage space, which has some really strict guidelines on what we have to do for qualified people. So income, assets, and credit. And this new product, like you're saying, non-QM, that's a non-qualified mortgage, which means that it's just kind of outside of the traditional Fannie Mae, Freddie Mac guidelines. And so what it is a way for us to not get into a person's income source. What we're doing is we're basing this loan off of the income potential on the property that you're purchasing. So what we're looking at doing is it's for rental properties, purchase or refinance, and we are just sourcing your income, so we have to have a 20% down payment, similar to other investment purchases with residential mortgages, and then the income potential is on the property itself. Yeah.
So the income potential, I'm sure, is like the biggest variable that exists as we go, as you're trying to be like, hey, this property is going to rent for $900. No, I think it's going to rent for $1,100. And it's going to be, probably a big difference on what type of loan you get, I'm assuming, right?
Yeah, and really the income potential is determined by the appraiser. So it's good to have a knowledge of the market as an investor to know kind of what you could expect to receive on rental income. But ultimately what we're doing is when we order an appraisal for this loan, we're ordering a rent schedule, and the appraiser tells us what we can expect to see on the rent. Yeah.
Okay. Yeah. And I want to take 2 steps back before we proceed that, just to give a little bit of context for everything. So are you like local to Asheville, and how did you get into the lending business?
Yeah.
And then we'll tackle all the nitty gritty about these non-QM loans, which it's just a fun thing to say.
Right. Well, I got into the business, I'm a loan officer. And I mostly do residential mortgages. And I got into the business about 2 years ago because I bought my house, and my first house, and I was like, I like my loan officer, I want to be like her. So I just made it a point to get into the business, and yeah, not looking back. It's a great job.
And so you've been doing this for 2 years, and now you're rolling out this new program, or you guys are rolling out this new program. So why did you all determine that this was a good fit? Is it an Asheville program, North Carolina program, or how big of a umbrella does it have?
Yeah, so the company I work for, Union Home, is a national company, and we are a direct seller servicer of Fannie, Freddie, and all the government products. So for the regular residential loan, that's really what we focus on. But as a company, we're always looking to expand products that we offer, and so we've decided to bring on a new investor and offer these non-QM loans just to kind of broaden our own portfolio.
Very cool. That's really exciting. I know that on the investor side of things, that's something that's hard to make work sometimes, is financing for rental properties. Just, there's different variations as far as, traditional mortgages isn't always necessarily the best fit, because if you bought too many things, then you don't qualify and whatnot. So this creates that different avenue, right?
It does, yeah.
So if I'm interested in doing this, what are the steps I need to take to prepare myself to come to you and have a conversation and be like, okay, yes, we can take the next step?
Yeah, really, it's good to know that it's difficult when you're buying investment properties. I think from a real estate investor perspective, because everyone's situation is a little bit different. So this loan is really good for people that are looking to buy long-term rental properties. It's not good for flippers because there are prepayment penalties.
Right.
It's a 30-year, you can do a fixed mortgage or a 7/1 ARM.
Okay.
And so it's really good for long-term.
So can we step back and explain what a 7/1 ARM is?
Sure. So a 7/1 ARM, ARM stands for adjustable rate mortgage. So that means when someone says 7/1, 5/1, 10/1, those are common terms that we use in the on the mortgage side. It just means that it's locked in for that amount of time. So a 7/1 it's locked, that rate is locked for 7 years. And then after the 7-year period, it starts adjusting. The rate can adjust every year after that.
Okay, perfect.
Yeah.
So what is the ideal makeup of a person who'd be using this loan?
Sure.
In your opinion, right? If you're like, yes, that's my ideal, that's the ideal person I want to help buy, a rental property or whatnot.
Yeah. Well, every mortgage lender is going to say someone with great credit. That makes our jobs a lot easier.
Fair enough.
And then, someone that has assets set aside for the down payment and is looking at a long-term investment. That's really what we're looking for there. It is the better credit you have, the lower interest rates you get on these loans. Okay. And the floor is at 5% on the 30-year fix, and then it kind of goes up from there depending on what your credit score is, things like that. So it is a good lower rate option than hard money would be, or commercial lending, because we're still in that quasi-residential range. Yeah, the rates aren't too terrible.
Okay.
But yeah, and you do have to own your own home. So if you're an investor,
you have to have a primary resident.
You do have to have a primary residence that you own. You cannot be renting. So that's one factor.
That's too bad. What about us who believe renting's better than being a homeowner? Then what? Just out the window, huh?
Yeah.
Have to rethink the whole renting versus home buying now.
Yeah.
Okay, so you own your own home. You got the 20% put down. You got good credit, great credit. Is there a benchmark?
The minimum is 660.
Okay.
Minimum credit score is 660.
Okay. And then the biggest question I personally have is, so I know that an appraisal goes out and looks at rent values and whatnot. What if a property is rented?
Yeah.
And you have rent history that's higher than what the appraised, than whatever the appraisal comes in? What would you do in that situation?
That's a tricky situation. If you own the home already and you're doing a refinance.
Like a refi?
Yeah, for a refi, we use whatever lease you have.
Okay.
So it's not based off of the rent schedule, it's based off of the lease then. Now, if you're purchasing a property that has renters in it, we will go off of the rent schedule that the appraiser does.
Even if you're inheriting the tenants and you're keeping their lease?
I'm pretty sure we would still look at the rent schedule.
Okay. Yeah. So if I could go, let's just as an example, say buy a house with hard money, right? Yeah. I own my own home. I've got above 650 credit. I do fix it up, and then I could go refinance it out with you all? Would that be an approach?
Yep.
And I'd still have to be bringing 20% to the table at that point? Or if there's equity, would that hedge?
Yeah, we would be looking at the equity in the home then.
Okay.
So as long as you have 20% equity, you wouldn't have to bring any more down.
Okay.
With the refi, you do have to, if you're going to refinance it, you have to have renters in place. So it can't be a vacant house.
Okay.
So keep that in mind. We have to see a 3-month history of rent.
So 3 month is the quote-unquote seasoning period?
Yes.
Okay.
Yeah. For the refi option.
And so how quickly is that process? So I got my tenants in there, they've been there for 3 months, and then I'm like, all right, hey Sarah, I'm ready to go, get into this non-QM product you have. How quickly does the refinance usually go on something like that, or what's a realistic timeline?
Yeah, for purchase or refi, I'd say the most realistic timeline is 45 days.
Okay.
Yeah. We can try to knock it out in 30, but
just plan for 45.
Plan for 45.
Probably don't get any extra unnecessary gray hairs.
Yes.
Okay, great. If I'm not super familiar with these, because most of the stuff we do is with, private or hard money and whatnot, not, non-traditional financing. Is there anything that we should be aware of as you're getting ready, or documents to have in place or anything like that?
Yeah, it's from a lender's perspective. Really, we're checking on your assets. That's probably going to be the biggest headache.
Okay.
because we have seasoning requirements on funds for down payment. So, we're just gathering 2 months bank statements, and we want to see that there aren't any large unexplained deposits on there. So it's best to have an account set aside with a large amount for down payment that we can just use and be like, well,
here you go.
Money.
So could you give me an example of maybe a situation where somebody might have the money, but maybe the way, like you said, no large deposits that aren't explained? Like, what are the variables around that as far as getting ready to get into this?
Sure. Well, with the large deposit thing, as long as we can source the money, it's okay. So if it's coming from like a sale of another property, we just would source the funds.
Okay.
It's just, we're always just looking for...
Want to make sure it's legitimate,
it's legitimate.
Their money.
Yeah, it's not just like you deposited $50,000 cash that came from nowhere,
Okay. Okay, fair. Yeah.
But that would be fine. That would be acceptable. We can also use, if you have large portfolio of stocks and bonds, we can use those accounts to show that you have the money set aside as well.
Can you use a variety of other rental properties to show? Like, I guess when you're talking about assets, I know you're primarily talking about like cash, right?
Liquid assets.
Liquid assets. Yeah. So there'd be no advantage for somebody to say, hey, I have 50 houses that are already part of my rental portfolio, I'm looking to add to it. That wouldn't like carry any weight in this situation?
No. I mean, we could do a cash out refi to leverage one of your properties, and then you could use that as a source for down payment on a new house.
Gotcha.
If you own them free and clear. Yeah.
Okay. That makes sense.
Yeah,
and you have to be still a primary owner, right?
Yes, you have to own your own house. Yeah.
That's a tricky one. Okay, cool. No, that's great. So as we're wrapping up on this, then, can you give me just an idea of how you think these are going to impact people here in the market? I know this is a newer product. I'm not sure if you all have seen a lot of them or kind of expecting to see a lot of them, and what role they might play just in housing in general.
We just rolled it out a couple weeks ago, honestly, so we haven't hit the market hard with it yet.
Right.
We do have a cap on how many we'll do for one investor, and that's 5. So we'll do 5 loans for you.
A year or?
Total.
Yeah. Okay.
So if you unload those properties down the road, we can look at adding more, but that's the maximum that we'll be doing for a particular investor. But I think it's a good option, I suppose, just for those investors that are looking to increase their portfolio, because we don't really care how many other properties you own. If you're looking at residential mortgages, qualified mortgages, we have that cap. You can only have 10 mortgage properties, but this doesn't really
take that into consideration. What if somebody wants to buy a property in their LLC or in an entity or a corporation?
Yep, they can do that.
And would the cap be either 5 per entity or 5 per corporation? Do you know?
That's a good question. I'll have to look into that.
Yeah, no, I just, because
if you have multiple LLCs and things like that.
Yeah, and if you have one LLC with partner A, and you want to buy 5 with that individual, and then you've got partner C over here, and you want to buy 5 together there. I'm just wondering if that'd
probably be a good way to get around it. Yeah. I'll have to do a little research on that particular one. But,
sorry, curveball, I know.
But that is a good point. You can do it in the name of an LLC.
Okay.
But everyone that's owner in that LLC has to be on the mortgage. So
is it a personal guarantee almost, or?
Yeah.
Okay.
So these are going to be reporting to your credit.
Gotcha.
So keep that in mind. It's like a quasi-residential commercial loan where it's somewhere the gray areas in between. So this is going to be, showing up on your credit report, and so anyone that's on that mortgage, especially with an LLC, if you're doing it in the name of an LLC, anyone that's a partner in there has to be included on the loan.
Okay, awesome. No, that's super helpful. Yeah. Do let me know about is it 5 per entity or 5 per LLC or whatnot as far as the cap, because that'd be, I don't know, it'd be very interesting to know.
Yeah, definitely.
What that ripple effect could be. Yeah. But no, I guess other than that, I don't have any other specific questions around that. Do you want to add anything, or did we just make sure we didn't miss anything? Again, I'm not super familiar with it, so.
No, I think we covered the basics. Really, it's an exciting product and something that I would enjoy doing. So
Cool.
Yeah, if you have anyone you know that wants to give it a shot.
Yeah, well, if anybody's listening or watching, what's the best way for them to get in touch with you so that they can ask probably the same set of questions I just asked you, but
Right.
for their specific situation?
Definitely. Well, you can reach me on my cell at 828-243-4687.
Okay.
Or you can send me an email, skatzmark@unionhomemortgage.com.
Do you want to spell that? I have a funny last name. My name's Afanador, and if I don't spell it, I've got it spelled every which way imaginable. So,
yeah, it's SKATZMARK.
All right, awesome. Thanks, Sarah.
Thank you.
All right, guys, thanks so much for tuning in. Now you have it. If you are looking to get into the landlording business, now you have a different alternative, a new option on the table. So really hope anybody who's intrigued by this, reach out to Sarah, and hope to see you guys at the next meetup here coming up in July or August, depending when you listen to this. Take care, everybody. Have a good afternoon.